On June 27, 2024, Nike stood in front of its investors and delivered a message nobody expected. The next fiscal year was going to be significantly worse than anyone had anticipated. The reaction from Wall Street was immediate and brutal. The stock plummeted about 12% in after-hours trading, wiping out roughly $15 billion of market value in a single session. But that drop wasn't the bottom. It was a warning sign. It was the definitive proof that the grand strategy the company had bet its entire future on had already failed. So, how did the undisputed kings of sports footwear get it so incredibly wrong? To understand how Nike found itself in this position, we have to look back to how the company was built. On January 25th, 1964, a middle-distance runner named Phil Knight and his former track coach Bill Bowerman started a company called Blue Ribbon Sports. In the beginning, they didn't even manufacture anything. All they had was a simple distribution deal. They imported running shoes from the Japanese company Onitsuka Tiger and sold them directly out of the trunk of Knight's car at local track meets. Their business model was straightforward: sell higher quality running shoes at a lower price point than the dominant German brands of the era, namely Adidas and Puma. For a while, that simple hustle was enough. By 1969, Blue Ribbon Sports was pulling in about $300,000 in annual sales. However, they realized a fundamental flaw in their business. They didn't control their own product, which meant they didn't control their own future. In 1971, the relationship with Onitsuka Tiger broke down entirely. Knight and Bowerman made the bold decision to build their own independent brand. They chose the name Nike, inspired by the Greek goddess of victory, and introduced the world to the now iconic swoosh. The young brand's first major technological breakthrough came from a kitchen appliance. Bill Bowerman experimented by pouring liquid rubber into his wife's waffle iron, creating a completely new kind of sole, one that was lightweight and provided unprecedented grip on running tracks. That experimental product became the Nike Waffle Trainer, and it propelled the company straight into the center of the American running boom of the 1970s. By 1980, Nike had gone public, and its market share in the United States athletic footwear market had climbed to a staggering 50%. The company that had started in the boot of a car was now the dominant force in sports, a position of absolute leadership it would maintain for the next 40 years, driven heavily by its legendary roster of athletes. From anchoring its basketball culture around Michael Jordan and LeBron James, to dominating tennis with Serena Williams and soccer with Cristiano Ronaldo, Nike wasn't just selling rubber and leather, it was selling the cultural capital of the world's greatest competitors. In 2020, Nike launched the Consumer Direct Acceleration Plan under CEO John Donahoe, a tech-focused pivot away from brick-and-mortar wholesalers toward its own digital apps and stores. While early pandemic e-commerce shopping masked structural flaws and sent stock to record highs, the strategy ultimately backfired. By pulling products from retail shelves, Nike allowed competitors like Hoka and On Running to claim market share. Simultaneously, the focus on data over athletic innovation caused Nike to neglect elite talent, resulting in a historic athlete exodus, including Neymar and Harry Kane. Following a silent product pipeline, massive layoffs, a shareholder lawsuit, and a $42 billion drop in market value, Donahoe was replaced by company veteran Elliott Hill in late 2024. Hill immediately initiated the Win Now Rescue Plan to reverse the digital experiment, restore retail partnerships, and reinvest in elite athletic icons. Though early metrics show signs of stabilization, steep drops in Chinese revenue and an aggressive tariff landscape mean Nike faces a long, grueling comeback. In June 2020, right in the middle of a global pandemic, Nike made a massive gamble. The sports giant announced its Consumer Direct Acceleration Plan, an aggressive pivot away from traditional retail partners like Foot Locker, forcing consumers toward Nike's website and digital apps. At the same time, they restructured, moving away from core sport categories like running and basketball to organize by broad demographics: men, women, and kids. At first, the gamble looked like a stroke of genius. Boosted by pandemic e-commerce shopping, Nike stock hit an all-time high of over $165 in late 2021. By 2024, the direct-to-consumer channel alone pulled in over $21 billion. Corporate leadership easily dismissed the warning signs, including the departure of veteran product designers who were deeply uneasy with this new, cold, data-driven direction. But underneath the stellar earnings reports, serious structural issues were creeping in. By pulling products off independent shelves to force app downloads, Nike left a massive retail vacuum. hungrier competitors like Hoka, New Balance, and On Running quickly moved into that empty shelf space, capturing the loyalty of everyday athletes. Worse yet, the obsession with digital platforms caused Nike to lose its grip on athletic culture. Elite talent noticed a severe lack of product innovation and support. Nike let valuable athlete contracts quietly expire, resulting in a historic talent exodus. In soccer, megastar Neymar left for Puma, and England captain Harry Kane walked away for a lifetime deal with Skechers. In tennis, Nike let its dominant hold on the world top 20 slip, retaining only a few anchors like Carlos Alcaraz and Yannick Sinner. The data algorithms were great at selling retro sneakers, but they couldn't invent the next groundbreaking performance shoe. The breaking point came in April 2024. In a stunningly candid interview, CEO John Donahoe admitted that remote work over Zoom had stifled bold innovation. The reality of a stalled product pipeline quickly caught up with the business. Nike announced an aggressive $2 billion cost-cutting plan and slashed 1,500 jobs, cutting deep into the marketing and design teams that gave the brand its soul. Then came the legal backlash. Shareholders hit Nike with a major class action lawsuit, claiming management misled them about the sustainability of the direct-to-consumer strategy. By late 2024, the damage was undeniable. Full-year revenue dropped 10%, net income plummeted 44%, and the centerpiece digital channel collapsed. In just 12 months, over $42 billion in shareholder value completely evaporated. Realizing the digital experiment had failed, the board ousted Donahoe and brought Elliott Hill out of retirement as the new CEO. Hill, a 32-year company veteran, immediately launched a rescue plan called Win Now to implement what he called a sport offense. Hill replaced 11 of his 15 top managers and began aggressively repairing relationships with retail partners, even returning to Amazon in a massive symbolic reversal. Hill also set out to win back the soul of the company. Nike pivoted heavily back to protecting and prioritizing elite athletic performance, reinforcing contracts with generation-defining icons like soccer superstar Kylian Mbappe and WNBA phenom Sabrina Ionescu. Early numbers show the old way of doing business still works. Wholesale revenue is rebounding while direct digital sales continue to slide, proving the direct-to-consumer mandate is officially being dismantled. Yet, a full recovery remains a steep climb. By April 2026, Nike stock sat 72% below its 2021 peak. External economic pressures, including catastrophic international tariffs on its Asian supply chain, are threatening profit margins, and revenue in China has dropped sharply while rival Adidas surges. Nike is not in financial ruin. It remains the largest athletic apparel company on earth, but its absolute untouchable market dominance is gone. As Elliott Hill himself notes, Nike is only in the middle innings of a long, painful comeback. Thanks for watching. Let me know what you guys think in comments.